Hello and welcome to the special coverage of Men's Investment Summit 2020. On the sideline of the panel, I'm in conversation with Abhay Pandey. He is a general partner at A91 Partners. So Abhay, welcome to the show. Your panel was about scaling up or the unit economics. So how, if I have to ask you, what is the strategy to get the right unit economics?
Thank you for doing this. Um, Unit economics is strangely something which is beginning to be spoken about when companies start growing up and fund flows are becoming scarcer. However, in my opinion, unit economics is something that you should be talking about right from the beginning of the company, at the stage of company creation, when the founders create the company, and when investors are talking to them. What is the potential of the company in terms of the profit pools available to the company, and irrespective of what strategy and approach you choose to build the business, can you see a large profit available at the 3, 5, 7-year mark for the company? Unit economics is the strategy could be different for different companies depending on the size of the market, competitive intensity, and capital available to capture that market. So there's no one straight answer for this. If you have a very, very large market and it's likely to be competitive, a great strategy could be raise more capital, ignore unit economics in the early years, but with a view that over the next 3 to 5 years it will converge. Do not lose that broader picture saying, hey, do not forget it, but you can push it back on the sidelines for a little while and focus on growth, because that becomes the most important thing as you want to eliminate competition or beat competition. But if the market size is small and it's not very clear if there's very large profit pools available at the end of it, you need to focus on unit economics right from the beginning. So it's really a function of market size, the profit pools, it's a function of competitive intensity. What's the price at the end of it? If the price is small, you can't spend a lot of money in growth and there's no unit economics then to be captured, because in the meantime, a lot of investors would have put in money and then finally no one makes a whole lot of money. So it's very tailored to what the situation is.
Since you are involved in a lot of first stage funding, there's a worry among global economists saying that there is a recessionary trend, funds are drying up. Are you facing that problem?
I think what most of us agree is that we've had a bull run for too long. It's the longest bull run in the history of the world. It's been on for more than 10 years and we haven't seen a bull run like this, and therefore there is a slowdown somewhere around the corner. That could be the next year, could be year after that, could be year after that. No one knows when it's really going to happen. And therefore you have to be watchful of it somewhere around the corner. Having said that, fund flows is not a problem right now. In fact, the world has a whole lot of liquidity. There's probably excess capital which is available across all stages of businesses, from early stage to mid stage to late stage. The amount of capital available to be invested in alternatives is at an all-time high. So it's a strange situation where there's a lot of capital, but nervousness that things will change and a recession is looming around the corner. So you have money to invest, but you have to be careful, and therefore it makes it very, very difficult for most fund managers like us as to at what rate do you invest. Do you go fast or do you slow down? What do you tell your company, grow or just slow down? And so on and so forth. So it's a very tricky situation that we're sitting in today.
But these red flags are more visible in Indian economy, A, because we were fighting with a slowdown in consumption demand, and B, because probably we are not very prepared to meet or to kind of tackle the global healthcare that's fast spreading. So in a situation like this, a fund manager sitting with probably a certain amount of fund, where do you invest and what kind of strategies do you have?
That's an interesting question. So the Indian slowdown, while we're talking about it today, started maybe 4 or 5 quarters back. And most people who are investing and looking closely at the market knew that this slowdown is coming. And if you look deeper, you knew that it's not going to revive very fast. And therefore, the kind of businesses that you're picking, the hurdle rate for us in terms of the underlying growth of the market changed. And that changed about a year ago. So if you're looking at a market which was growing at 10%, you wanted to now invest in a market which was growing faster, because you said if the market is slowing down, then even if you're a very high-performing company within that sector, your growth rate will finally be dependent on what the market growth is. So the hurdle rate of what the growth rate of an underlying market in which you're investing went up 4 to 6 quarters away for most investors. And when I say a sector, it does not mean a sector is a very in a very broad sense. When I say sector, I mean if you take FMCG, within FMCG there's personal care. Within personal care there's color cosmetics. So you have to look at each underlying subsector and say how much is skincare growing it, how much is hair care growing it, how much is color cosmetics growing it, and are there any subsectors within the sectors that I'm looking at growing at a rate which is much higher than the underlying sector. And those are the decisions that people started making, saying if we start focusing on underlying really small subsector, that's the way to defend yourself against a slowdown in the economy.
But going forward, as you mentioned about the subsectors within the umbrella sector, in the FMCG sector or in the consumer sector, any particular segment that you think will probably kind of get away with this rough weather?
No, everybody will be impacted. Everybody is being impacted. Let's put it this way. But there will be pockets that will grow faster than others. So, and the sectors that will grow faster are sectors where some of the underlying trends of either social media changing behavior, because social media is prevalent and growing, or there's a greater trend from unorganized to organized. Take some smaller segments of packaged food, or certain segments of packaged food and beverages, again where there's a trend of moving towards, let's say, lower priced juices and so on. Or there are certain trends where certain sectors where the penetration is very, very low. Take an example of sanitary pads for women. These are sectors where you'll see high growth irrespective of what's happening in the economy. Now, that growth could have been 25% a year ago. It might be 22% now and could be 18% in the future, but still the underlying growth is way higher than where the core economy is growing. And therefore, as investors, our job is to find those subsectors where you are seeing higher than normal growth.
Right. So if I've understood you correctly, you are looking at probably segment within the bigger umbrella. So if this is the investment strategy adopted by many fund managers, in the next 4 to 5 years, some sectors or segments will have a better growth than the rest, right?
Oh, absolutely. So if you look at financial services as an example, nothing in the Indian ecosystem or economy will grow unless financial services engine is working well. And that's probably the single largest reason for the slowdown is the credit cycle is not working as efficiently as it should work. But within that, if your large PSU banks are not lending because they've lent poorly in the past, a number of wholesale NBFCs
are... NPAs writing on the books.
That's correct. A lot of large NBFCs, the wholesale ones in particular, not lending because they're sitting on a problem. That's an opportunity for many smaller NBFCs and the more agile private banks to capture market share. And therefore, from our perspective, if you're looking at the NBFCs, you're saying, hey, if the core sector grows at 6%, can there be NBFCs that are still growing at 50%? You will find certain NBFCs that are growing at 50% because they're filling up for a large gap because a significant portion of this is public sector owned, a lot of people are either dead or in coma. Or on the deathbed and being infused with fluids.
So it's finding the right opportunity and grab it.
So it is absolutely that, but you have to be careful about saying, if you can pick underlying trends, take insurance as an example. We know penetration is poor. We know a significant part of the sector is still public sector. So the movement from public to private will happen. Penetration will grow. As a result, put these two together, you'll get a sector that's growing at more than 20%. Right. Within that, if you can find a player which is growing at 50%, go for it.
On that note, Abhay, thanks a lot for this insightful conversation.
My pleasure. Thank you.
So for more details and updates, stay tuned.